Hello friends, welcome to the September edition of Monthly Viewpoints. Global equities saw high volatility in the month of August due to negative headlines on the US-China trade war. In India also, due to some pessimism on the economic slowdown, we saw high volatility and we saw the large cap Nifty index ending the month flat, but the mid cap and small cap indices declining about 1.5 to 2%. India's first quarter GDP number came in at 5% versus expectations of 5.7% year over year. There is now a meaningful risk of downside to the RBI's projection of 6.9% for the full year FY20 real GDP growth. Slowing economic growth momentum and the continuing crisis in the NBFC space could have serious implications for the economy unless addressed in a very specific manner. Fortunately, we have seen some response from the government in the past few weeks. The finance minister has announced quite a few measures to address the concerns regarding the economy. The surcharge on the capital gains for domestic as well as foreign investors, which was announced in the budget, has been reversed. Various other measures have been announced to address the interest rate transmission, liquidity and credit flow, mitigate the slowdown in the automotive sector, and also attract foreign investment in select sectors. Lastly, the government has also announced an amalgamation of 10 public sector banks into 4 large banks. With larger, cleaner balance sheets and merger synergies, the expectation is that this will lead to better credit growth in the economy. On the monetary policy front, the RBI had cut rates by an unconventional 35 basis points at its last meeting. This has led to a cumulative 110 basis points of rate cuts in this calendar year till date. We expect a further round of easing with cuts of between 60 to 75 basis points in the current cycle and a rate cut expected in October. The government will also receive about 1.76 lakh crores from the RBI in the form of a dividend and a transfer of the excess capital. The expectation is that the government will use these funds to increase the liquidity in the economy. Coming to the monsoons, we have seen a strong progress of the monsoons over the past month, and the cumulative rainfall at the end of August now stands close to its long-term average. This bodes well for the rural economy, and we should see the rural economy getting a boost. Coming to the first quarter earnings, aggregate revenue, EBITDA and PAT for the large cap Nifty index have come in at 7%, 2% and 3% year over year. The earnings growth has been broad-based. However, for full year FY20, the earnings number has been downgraded by about 5%. On the global front, an escalation in the US-China trade war has led to increased volatility and deterioration in the global growth outlook. In response, global central banks have continued their shift to a more dovish stance, which also helps the RBI to cut rates further. With global growth slowing down, Brent crude prices have also remained below $60 per barrel, which is actually quite beneficial for India. However, the Chinese currency has depreciated below the psychological threshold of 7 to the US dollar, and in response, the rupee has also depreciated more than 3.5% in August to reach levels of around 72 rupees to the dollar. Emerging markets have seen significant FPI outflows in August, and India was no exception, seeing an outflow of around $2.3 billion last month. Coming to our view on the markets. In terms of valuation, we think valuations are in favor of long-term investors right now. If we look at the large cap Nifty index, the 1 year forward PE and PB multiples are close to the long-term averages. Even for the mid-cap and small-cap indices, the trailing PE multiples are either close to or below the long-term average, indicating that valuations are quite reasonable. Overall, we believe that the risk-reward for equities is fairly balanced and valuations can offer reasonable returns for long-term investors. Now, market performance in the short term could be modest. However, as we see some green shoots in the economy, especially during the festive season, the market sentiment and market performance can improve. We remain bullish on the Indian economy in the next 3 to 5 year time frame. Hence, we would suggest that investors continue to build equity exposure for the medium to long term, especially through SIPs. We recommend that investors can allocate around 20% of their corpus to mid-cap and small-cap funds. In terms of interesting themes, we are looking at consumption, which includes the low-ticket consumer durables, consumer staples and real estate sectors, financials, which includes private banks, corporate banks and select NBFCs, pharma and healthcare, and IT. We offer a basket of suitable funds for investors to choose from. Thank you and happy investing.